Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 2, and this is Section C. This is an application topic. Calculate the carrying amount of inventory and prepare journal entries using various costing methods. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you go check out our free 1-hour webinar training where we go over the key ingredients to passing the CPA exam. Among those is, again, going to the questions first, studying in the morning for 2 hours, making sure you review every day, things like that. We will teach you the key ingredients so that you can pass the CPA exam efficiently and effectively without wasting months or even years of your time. Also, just letting you know, we will only be going over 5 questions in today's video, whereas SuperfastCPA Pro members will have access to the full 10-question video when we post it in the members forum. So if you like this and you like our other videos and our other products, you can get more of it by becoming a SuperfastCPA Pro member. And with all that said, let's dive straight into the questions. All right, here we are at question 1. Something we always like to point out as a good strategy is always looking at the last part of the question to see what the real question is. This will give you context as you're reading through the rest of the question so that you know what information you actually need. It's not always helpful, but it is a good habit to be in so that when it is helpful, it's very helpful. So let's go ahead and read this last part. What is the carrying amount of PineCo's inventory as of March 31st? Okay, so we know that based off of this blueprint topic, we're calculating the carrying amount of inventory. Let's go up here. PineCo has the following inventory information for the month of March. Beginning inventory, 3,000 units at $20 per unit. Purchase on March 10th of 5,000 units at $22 per unit. A sale on March 15th for 4,500 units. Purchase on March 20th, 2,000 units at $25 per unit. Sale on March 25th, 3,000 units sold. Purchase on March 30th, 1,000 units at $28 per unit. So with all that information and this information, PineCo uses the Perpetual LIFO method to account for its inventory. So now that we know it's Perpetual LIFO, with all that information, what is the carrying amount of PineCo's inventory as of March 31st? Now, if you have any experience with LIFO, you might be able to figure this out. So pause the video if you'd like and go ahead and try to do this. If you don't really know what LIFO is or what Perpetual LIFO is, that's okay. We're going to dive straight into the answer to learn how this works because, again, that's the idea behind going through the questions is you use them as your learning material. So, again, if you want to try for yourself, pause the video. If not, let's go ahead and look at the answer together. All right, here we are at the answer. The answer is B, $78,000. And we're going to walk through this. By the way, all of these calculations seem like they're quite involved, but really they're not too difficult once you get the hang of them. So the idea behind all of these questions is to walk you through step by step how to do them. So with LIFO, Perpetual LIFO, we're going to go through this. So we have to calculate the inventory balance after each transaction using Perpetual LIFO. And that's what Perpetual means. As it's going, you're making the calculations as you go. And just a reminder, LIFO is last in, first out. So that's going to be the theme as we walk through this. So we have the beginning inventory, which was 3,000 units at $20 per unit. That's $60,000 worth of inventory. There was a March 10th purchase. So that was 5,000 units at $22 per unit, and that's $110,000. So as of March 10th, perpetually, the inventory equals $170,000, which is the 3,000 units and the 5,000 units so far. Now, there's a sale on March 15th. So with LIFO, again, it's last in, first out. What does that mean? It means the most recent purchase, the last thing that was into the inventory, is the first thing that you're going to sell. So they sold 4,500 units, and that is going to come out of the most recent thing that was purchased, which is these 5,000 units at $22 per unit. So 4,500 units at $22 per unit, because again, it's coming out of these 5,000 units. That gives us $99,000 of cost of goods sold. And then that leaves in the inventory the still remaining 3,000 units from the beginning. Those were at $20 each. And then there's still 500 units left of these 5,000 units that were purchased on March 10th at $22 per unit. So that is the remaining inventory after this sale. So it's $71,000. Now let's go to the March 20th purchase. There was 2,000 units that were purchased at $25 per unit. So that's $50,000. And that is now added to the inventory. So again, still the 3,000 units from the beginning, up here, sorry. The 500 units left after this sale on March 15th. And then now there's the 2,000 units at $25 per unit on March 20th, so the inventory is now $121,000. Let's scroll down a little bit further just to see the last part of the question here. So $121,000. Then on March 25th, there is another sale. So we sell 3,000 units, again, using the most recent things. So what is the most recent purchase? it's going to start with these 2,000 units here that were bought at $25 per unit. And now that those are gone, we have to go to the next most recent thing, which is these 500 units that are left over from this purchase on March 10th. So they are worth $22 per unit. And then there's still 500 units that need to be sold. So now we finally are going to break into those beginning units that we had at the very beginning of the month, 3,000 units. So there's going to be 500 of those units of the 3,000 from the beginning to finish the 3,000 units that are being sold on March 25th. So again, all 2,000 units from the March 20th purchase, the remaining 500 units from the March 10th purchase, and then now we're using also 500 units from the original beginning inventory. So add that all together, the total cost of goods sold is $71,000, and the remaining inventory after all that is the 2,500 units of the beginning inventory that are left, and those are still at $20 per unit, so that's $50,000. And then finally, to finish, there was another purchase on March 30th. That's 1,000 units at $28 per unit, so that's $28,000. You add that to the inventory that was left after that March 25th sale, and you add those together, and that gives you $78,000 of ending inventory, or the carrying amount, as in how much it will be carried forward into the next month as, is $78,000 using perpetual LIFO. So again, perpetual LIFO is basically just using LIFO, but you do it as you go throughout the month. So you're doing it with each purchase and with each sale, especially the sales, of course. With the sales, you are taking into account the most recent thing purchased. So that's LIFO, perpetual LIFO. That's one of the ways you can calculate the carrying amount for inventory. And one thing I want to point out is you'll notice that we were calculating COGS as we went through. COGS seems to be something that is also quite heavily tested for when it comes to inventory, even though it's not explicitly stated in the blueprints. So I am going to make another video after this video where we're going to approach the things that we cover in this video, but instead of from the carrying amount of inventory, we're going to be approaching them from the cost of goods sold perspective. Looking at similar things, but calculating a different number. That's what we're going to be doing in the next video, because again, it does appear to be something that is also heavily tested alongside calculating the carrying amount of inventory. So with all that said, let's go to the next question. All right, here we are at question 2. What is the carrying amount of Janssen Co.'s inventory as of September 30th? By the way, that's probably going to be the same question for almost all of these. So, but it's still good to read that last part because it's good to be in that habit. Now let's go up here. Janssen Co. uses the perpetual FIFO method to account for its inventory. The following transactions occurred during the month of September. So September 1st, they had beginning inventory of 1,000 units at $12 per unit. September 5th, they purchased 1,200 units at $14 per unit. September 10th, they sold 1,500 units. September 15th, they purchased 800 units at $15 per unit. September 18th, sold 700 units. September 22nd, purchased 600 units at $16 per unit. And finally, September 27th, they sold 500 units. So with all that information and knowing that it's perpetual FIFO, not LIFO, we have to figure out the carrying amount of the inventory. Now, if I'm being honest, based off of what we learned in the previous question, I know we went over perpetual LIFO in that question, but you should easily be able to apply that to the perpetual FIFO in this question. So I'm going to have you pause the video, do the calculation. Remember, FIFO is first in, first out instead of last in, first out. So just think about what that means. I'm pretty sure you can figure out the difference between LIFO and FIFO there. So try this. I think you can figure it out. And when you're ready, come back. We'll look at it together. All right, here we are. The answer is D. $14,100 is the carrying amount of the inventory at the end of the month using the perpetual FIFO method. So let's walk through this again. It's almost exactly the same, but with the focus of first in, first out instead of last in, first out. So we're going to walk through this. Beginning inventory, again, that's the 1,000 units at $12 per unit. That was $12,000. September 5th purchase, they purchased 1,200 units at $14 per unit. That's $16,800. So we add that to the total inventory now. So the 1,000 units at $12 per unit and the 1,200 units that we just purchased, that's $28,800 of inventory that we have now. Now on September 10th, they sold 1,500 units. Now with FIFO, you're using the oldest costs, the very first things that you purchased. So with that means that you're going to use the beginning inventory first. So there's 1,500 units. We have to use all 1,000 of the units that were there at the beginning of at the beginning of the month. So that's 12,000 units used there. So that's $12,000 or 1,000 units used there. And then we still have 500 units left that we need to sell. And those are going to come out of the next oldest thing that we purchased, which is these units from the September 5th purchase. So 500 units from this September 5th purchase. Altogether, the COGS is $19,000. and there's now in the inventory left, there's still 700 units of the September 5th purchase left at $14 per unit. So that's $9,800 that the inventory is at now. Now let's scroll down just a little bit more so we can see the whole thing. Okay, so now we can see the whole thing. So again, 700 units left of the September 5th purchase. Now as we go on, they purchased another 800 units at $15 per unit on September 15th. That's $12,000. So we add that to the total inventory. So the 700 units that were left after the sale and the now 800 units that we just purchased, that gets us to $21,800 of inventory. Now we go to September 18th. There was another sale and it was of 700 units. Now remember, with FIFO, we are using the oldest first. So that means that we're using the remaining 700 units from this September 5th purchase. And again, that's the amount that was in the inventory here after the September 10th sale. And that gets us, again, $9,800 of cost of goods sold. That's the same as the inventory that was left after that September 10th sale. And that leaves us with the remaining 800 units that we just barely purchased on September 15th. So those are still sitting there, still $12,000 worth of inventory from the September 15th purchase that is sitting in the inventory. Now we go to September 22nd. There was another purchase of 600 units at $16 per unit, $9,600. So we add that to the total inventory. So again, now it's the 800 units from the September 15th purchase and the 600 units that we just purchased on September 22nd. That gets us to a $21,600 inventory. And then finally, the last thing is on September 27th, they sold 500 units. And again, that's going to come out of the oldest purchases that we have. So the oldest purchases that we have are these 800 units from September 15th. So it's going to come out of those 800 units. So 500 units at $15 per unit, that gets us $7,500 of cost of goods sold. And with that, we still have 300 of those units left. So we can see that right here. And then all 600 units that we purchased on September 22nd. So we add that all together and that gets us $14,100 of inventory that's left. Now the calculations are very similar as far as how you go about it as you go through if you're using the perpetual method. But of course, with FIFO, the focus is with first in, first out, as in you're using the oldest stuff first. I hope that makes sense. Let's go to the next question. All right, here we are at question 3. As always, read the last part. What is the carrying amount of Harper Co.'s inventory? Okay, again, we know that we're doing that for this video, but let's see what we have to do. Harper Co. uses the periodic LIFO method, so that's different than the perpetual that we looked at before, to account for its inventory. Following transactions occurred during the month of December. So they had the beginning inventory of 600 units. They purchased another 1,000 units. They purchased another 800 units on December 15th. And sorry, that other 1,000 units was on December 8th. December 21st, they purchased another 400 units. And on December 31st, they sold 1,900 units. So with all that, we have to figure out what their carrying amount of inventory is, but we have to use the periodic LIFO method. If you have no idea what that is, that's okay. We're going to dive straight into the answer. If you have a guess or if you've seen this before, of course, pause the video and do the calculation yourself. But let's go ahead and look at the answer if you don't know how to do it. All right, here we are. The answer is B. $16,800 is going to be the carrying amount of the inventory using the periodic LIFO method. Now, this is actually very simple. I really didn't understand this at first when I was studying it. I was like, this makes no sense. But I was able to eventually understand it, and I hope that I can teach how to do it in this question very clearly. So let's go through this. When using the periodic LIFO method, the inventory is calculated at the end of the period, and the sales are matched against the most recent purchases. Now, the way that this is done could be a little bit confusing, but it makes total sense as you go through it. So let's go through this. So first we have to calculate the total units available, and then of course we have to calculate the ending inventory. But first we have to calculate the total units available. So to start, we have 600 units from the beginning, 1,000 units from December 8th, 800 units from December 15th, 400 units from December 21st, and that gets us to 2,800 units available for when the units are sold, which 1,900 units were sold. So that leaves us with an ending inventory of 900 units. We're focusing on units first. We're not focusing on the cost. So now that we know that the inventory has to end with 900 units, we go here. Since LIFO sells the most recent purchases first, the oldest inventory costs remain as ending inventory. So this is the part that was confusing to me until I saw it kind of similar to this. You're taking these 900 units, and remember, these 900 units are what is left after things are sold. So this is what is going to be there at the end of the month. So with LIFO, you are assuming that these 900 units are the oldest units because, remember, with LIFO, last in, first out, you're selling the newest stuff first. So since we know these 900 units are the oldest units possible, we then go over here and we start with the oldest units, the beginning inventory, we use 600 of those units at $18 per unit, and that's $10,800. And then since that used up all 600 of the beginning units, that means that 300 units of the December 8th purchase are left. So that gives us $6,000 there. So you add that together, that's $16,800. It's completely different from the perpetual LIFO method. It's easier, but it's probably less accurate, especially if there's a lot of fluctuation throughout the month, like lots of big sales, lots of big purchases, and they're different amounts. The periodic LIFO method isn't going to be as consistent or as accurate, but it is something that you could be tested on for the CPA exam. So just remember, with the LIFO periodic method, you're first figuring out how many units there are to use in the month. You take away the units that were sold. That leaves you how many units are left at the end of the month, meaning those are the oldest units. And so you apply those to, again, the oldest units, not the newest, because even though this is LIFO, that might be confusing. You apply it to the oldest ones because those are the ones that you're assuming are left. So I hope that helped. This is something that I was very confused about when I was studying, and I tried to explain it in a better way here. Now let's go ahead and go to the next question. All right, here we are at question 4. Which of the following is the correct carrying amount? Okay, yep, we know that's the question almost every time this time. So let's go up to the top. Kerrigan & Co. had the following inventory transactions during the month of October. They had beginning inventory of $30,000. They purchased $27,000 of inventory, and that was FOB shipping point, and that was received on October 12th. October 14th, purchased $24,000 of inventory, and that was FOB destination, received on October 18th. October 20th, they sold inventory worth $81,000 for $90,000. FOB destination goods arrived at the customer's location on November 2nd. October 28th, purchased $39,600 of inventory, and that was FOB shipping point, received on November 1st. Okay, so you've probably seen this before, FOB shipping point, FOB destination. If you don't remember how that works, that's okay. We're going to dive straight into the answer to do this together. All right, here we are. The answer is C, $120,600. Now, this is a pretty simple concept. There's a lot of words here, but it won't be too hard to go over. So let's go over this. FOB shipping point, just a reminder, what that means is that ownership transfers to the buyer as soon as the goods leave the seller's location. So the buyer is responsible for these goods during transit, and they should be included in inventory as soon as they are shipped. So when somebody sells something to another person, the moment those are shipped, they are in the ownership of the person who bought them. That's what FOB shipping point means. FOB destination is the opposite. Ownership transfers to the buyer only when the goods arrive at the buyer's location. So the seller is in charge of them all the way up until they arrive at the customer. So these are the two sides. FOB shipping point, ownership transfers as soon as it's shipped. FOB destination, ownership doesn't transfer until it arrives at the location. So now that we know how that works, let's go down a little bit further to do the calculations. All right, now we've scrolled down a little bit more, just letting you know, whenever you see a question like this that isn't mentioning something specific like the FIFO or LIFO or whatever the case may be, you're just using the normal formula for ending inventory. And that would be the beginning inventory plus the purchases less the cost of goods sold equaling the ending inventory, which again, ending inventory is the carrying amount of the inventory as it's being carried forward into the next month or the next quarter or whatever the case may be. So let's keep this formula in mind. Beginning inventory was $30,000, so that's the beginning inventory right there. We add purchases. That's part of the formula right there. Now let's go through these purchases to see which ones actually are going to be counted in the inventory. So the October 8th purchase was $27,000. It was FOB shipping point. So since they're the one purchasing it, what does that mean? That means that as soon as it was shipped on October 8th, it is included in the inventory of Kerrigan. So that is going to be in their inventory. Next, let's talk about October 14th. That purchase was $24,000. This was made FOB destination. So, okay, they don't have ownership of it until it arrives, but luckily it arrived October 18th within the same month, so it is also included in the inventory. Now for the October 28th purchase, that one was $39,600. This was FOB shipping point. Now, this could have been a little bit confusing, especially because it didn't say a specific date that it was shipped, but the fact that it was received on November 1st, you would probably assume that it was shipped on a previous day to November 1st. Now, of course, we're assuming there, and I don't love doing that, but you can assume that this was shipped in October. Since this was shipping point and it was shipped in October, that means that even though they didn't receive it until November, that is going to be included in their inventory. Now for cost of goods sold. No cost of goods sold is recognized in October because the sale on October 20th was FOB destination and ownership did not transfer until November 2nd. because they shipped it in October. But again, since it was FOB destination and they're the ones selling it, that means that the customer did not have ownership and they did not take responsibility for that stuff that they purchased until November 2nd when they received it. So because of that, they still have that considered in their inventory. If it had been FOB shipping point, COGS would have been $81,000 because that's how much that inventory was worth. And again, with shipping point, it would have been counted in the customer's inventory as soon as it was shipped, which would have been in October. But since it wasn't shipping point, there was no cost of goods sold because, again, that's still going to be in the inventory of Kerrigan. So there was no cost of goods sold in October because it was FOB destination and it didn't get to the customer until November. So with all that information, again, now we're using the basic inventory calculation, right? The ending inventory calculation. We take the beginning inventory, we take all the purchases that did, in fact, they were included. So 27,000 from October 8th, 24,000 from October 14th, 39,600 from October 28th, and that gets us $90,600 of purchases. Now, again, because the October 20th sale was FOB destination, it's still going to be considered a part of the inventory. So there was no cost of goods sold because that still stayed in their inventory. So the ending inventory is just the beginning inventory and the purchases, getting you to $120,600 of ending inventory, which again is the carrying amount into the next month. So I just wanted to make sure you knew what FOB destination and shipping point were and kind of just reminding you of the basic ending inventory calculation. Let's go to the next question. All right, here we are at question 5. What is the carrying amount of inventory that Grant & Co. should report at the end of the year for using the dollar value LIFO method? Now, this is to me, the dreaded dollar value LIFO. So Grant & Co. began using the dollar value LIFO method in year 3. So that's when they started using it, when its inventory was valued at $150,000. By the end of year 4, the ending inventory at the current prices is valued at $210,000. And the relevant price index for year 4 is 1.25. So now again, with all that information, we have to figure out the dollar value LIFO or the carrying amount of the inventory at the dollar value LIFO method for year 4. And this is something that I struggled with when I was studying. So I've tried to make sure that I explain it very clearly as we go through this. So if you know how to do this, that's fantastic. Pause the video and do the calculation. If not, let's dive into this. It's actually not too bad once you know how to do it. So let's look at it. All right, the answer is C, $172,500. That is the carrying amount for the inventory using the dollar value LIFO method. So let's walk through this. Again, it's not too bad, but you need to know the steps. So let's scroll down a little bit so we can see all the steps at once. Okay, here is all the steps at once. So step 1, you have to calculate the ending inventory in base year dollars. Convert the current value of inventory back to base year dollars to determine if there is a real increase in quantity after adjusting for price changes. Okay, so what it means is base year dollars is meaning based off of the first year that they started doing dollar value LIFO, we have to, again, figure out how much the ending inventory in year 4 is worth according to the amount of money that there was in year 3. Now, I know that's kind of confusing, but the base year is the year that they started doing dollar value LIFO. So we're going to walk through this and I'll try to show you what that means as we go. So the formula for calculating the ending inventory in base year dollars for year 4, which is the ending inventory at current prices, which again was $210,000, divided by the price index. And you'll be given that price index. You shouldn't have to figure that out. So $210,000 divided by 1.25, that gets you $168,000 of inventory based off of the previous year, the base year dollar value. Basically, the idea, I guess, is to value it as all cash. You're not looking at it as units or anything like that. But again, this $210,000 of year 4 ending inventory, as if it was year 3 inventory, it would have been worth $168,000. So now we take that amount, we go to step 2. We determine if there is a layer increase. And that basically means you compare this $168,000 to the base year dollars of $150,000. And we can see that $168,000 less $150,000, that's $18,000 greater from year 3 to year 4. So there is a layer of $18,000 in year 4 based off of the year 3 base dollar amount of $150,000. Now that we know that base amount of $18,000, we calculate the value of the new layer. So we take this new layer that we just calculated and we apply the index to it again, but instead of dividing it, we multiply it. So $18,000 multiplied by 1.25, that gets us $22,500. So that is the current year value of the new layer. Now we add that in step 4 to the original base layer, the $150,000 that they had at the end of year 3, the year that they started doing dollar value LIFO. So the total dollar value LIFO is $172,500. Maybe pause the video, walk through that multiple times to make sure you understand it. I feel like it's hard to explain. So walk through this multiple times if you need to, pause the video. And with that, we've explained a lot, we've gone over a lot. This is kind of a long video. So before we go any further or do anything else, let's do one more part of the SuperFast CPA process called pillar topics. So the idea behind pillar topics is as you're going through the material, you will notice the things that keep popping up in the questions. You'll notice that they've had 2 or 3 questions trying to teach you how to do the LIFO perpetual method, or you've seen 3 or 4 questions trying to teach you about FIFO, or whatever the case may be. You've seen the same thing multiple times, maybe in slightly different forms, but you know it's important because your review course is trying to teach you it. So you take a second, you write down these pillar topics, kind of a summary of what you learned, the most important things in your own words, so that as you go, you're building these pillar topics day to day, and you know the most important things for the exam as you go on. So let's go ahead and go to the pillar topics for this video. All right, here we are at the pillar topics. So let's go through this. FIFO, again, is first in, first out. Inventory sold is valued using the earliest, again, that's the oldest, costs first. So ending inventory consists of the most recent costs. In times of rising prices, FIFO results in lower COGS and higher ending inventory, which makes sense because if you think about it, if prices are going up, but you're constantly using the oldest stuff, that means you're using the cheapest stuff, which means your cost of goods sold is lower. But it also means that your inventory is more expensive because you're using the less expensive stuff first. So the inventory is going to stay more expensive because prices are rising. So that's something to think about. You could apply the same thing to LIFO in the opposite manner. Let's go ahead and look at the LIFO perpetual. Inventory sold is valued using the most recent purchase cost at the time of each sale. Ending inventory is calculated by adjusting the cost after every purchase and sale, making it more detailed than LIFO periodic. For LIFO periodic, inventory is valued at the end of the period, using the most recent costs first for all the units during the period. It results in different COGS and ending inventory compared to LIFO perpetual when prices fluctuate within the period. So again, LIFO periodic, less accurate, but a little bit easier to calculate because you just take it at the very end of the period instead of having to calculate it as you go. Dollar value LIFO, this is hopefully something you won't be tested on too much, but I wanted to make sure that I talked about it. And again, I hope that you can use that question that I created to help you understand it. This measures the inventory changes in dollar value, not units, by converting current inventory to base year dollars. New layers are added when base year dollar value increases, and each new layer is indexed at current prices. So again, you're trying to figure out how much each layer is worth at the base year dollar amount, like compared to the base year, and then you figure out how much it's worth in the current year, and that will tell you the carrying amount of the inventory. I don't think, and I hope it's not something that will be super heavily tested, but I want to make sure you know what it is. And then finally, FOB shipping point and destination. This one's not too difficult. Shipping point means that the ownership transfers when the goods are shipped, and the buyer includes them in inventory once they're shipped. And for FOB destination, it's the opposite. Ownership transfers when goods arrive, meaning that they stay in the ownership of the seller all the way until the buyer receives them, and then finally the buyer has them in their inventory at that point. So we went over a lot in just 5 questions, and these were the pillar topics. I know this was kind of a long video because these can be kind of involved calculations. I hope this was helpful. Before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, we will go over the key ingredients to passing the CPA exam, and we will teach you how to be effective and efficient with your studying. Things like studying for 2 hours in the morning, going straight to the questions to learn the material, because again, you're not going to be watching lectures on test day. You're not going to be reading a textbook on test day. You're going to be answering multiple choice questions and sims. So do that as your main learning material because you need to know how to do that. We're going to teach you those kinds of things at the webinar, so make sure you go check that out. Also, just a reminder, we only went over 5 questions in today's video, whereas SuperFast CPA Pro members will have access to the full 10-question video when we post it in the members forum. So if you like this and you like the other things we're doing, make sure you become a SuperFast CPA Pro member and you will get access to a lot of other resources that we have. Again, I hope this was helpful. I know we went over a lot, and I will see you in the next video.